we start our presentation, this is the case study that we choose for our topic. So firstly is management assertion.
Management assertion are implied or expressed representation by management about classes of transactions and the related account in the financial statements. Auditors must therefore understand the assertions to do adequate audits. Under ISA 500, audit evidence classifies assertions into 7 categories. First, existence. Second, occurrence. Third, rights and obligations. Fourth, completeness. Fifth, valuation or allocation. Sixth, measurement. And last, presentation and disclosure. There are several management assertions that are relevant to the case study. First, occurrence and existence. This is because all transactions in the accounting period actually took place, and the objective of existence deals with whether recorded transactions have actually occurred. For example, the sales order accepted through postal mail and telephone are handled by Ms. Chang at Accounts Club, who will immediately raise the sales invoice in quadruplicate copies. Because of close similarity between the existence and the occurrence assertions, they may be combined and classified under one category. Next, completeness. This is because all transactions and accounts that should be presented in the financial statements are recorded. For example, customers are given a 1-month period to complete their dues by checks. Therefore, Ms. Chang will prepare the deposit slips every day for the checks collected through postal mail and hand over to the cashier for depositing in the bank. After that, she will post the transactions of the checks collected to the ledger to the credit of the respective customers. The failure to record sales transactions that actually occur will be a violation of the completeness assertions. Last, valuation and allocation. This is because the balance that are included in the financial statement are appropriately valued and allocation adjustments are appropriately recorded, such as Ms. Chang prepares a schedule of accounts receivable on the 3 months and reconciles it with the account receivable control account. She also prepares bank reconciliation statements as in 2 months. Therefore, the sales transactions are properly classified, recorded on the correct dates, and are correctly summarized.
Firstly, recorded transaction exists. This objective deals with whether recorded transactions have actually occurred. Next is completeness. This objective deals with whether a transaction that should be included in the journals have actually been included. Next is accuracy. Recorded transactions are stated at the correct amounts. Classification. The client's journal is properly classified when transactions have been included. Next is timing. To record the transaction on the correct date. Lastly is posting and summarization. What happens when recorded transactions are properly included in the master files and correctly summarized. Next, we will discuss about the study on July 2020. First objective that we clarify is the company needs to make sure that transactions have actually occurred. Therefore, the sales order received through postal, mail, and telephone are handled by Ms. Chang and accountant clerk, who will immediately raise the sales invoice in quadruplicate copies to show that recorded transaction exists. For the second objective that we clarify is Ms. Chang wants to achieve the objective through completeness, which deals with whether all the transactions should be included in the journals that have actually been included. In this situation, Ms. Chang will prepare the deposit slip every day for the checks collected through postal mail and hand over to the cashier for depositing in the bank. Under valuation or allocation objective, it has 4 general objectives that Ms. Chang needs to reach. First is accuracy. Ms. Chang sends reminders to customers for the shortage or differences in the amount received. On receipt of suitable replies from the customer, Ms. Chang will credit their account as a rebate or an allowance. Next is the transactions that include in the customer invoice are properly classified. When Ms. Chang has retained the last copy of each invoice, raise and forward the original and duplicated copy to the Encik Saiful. After that, Encik Saiful keep the copy as a record and forward another copy to the stores together with the dispatch. Advice for delivery of goods. The next objective under valuation or allocation is Ms. Cheng was sent the original copy of the sales invoice to the customer directly by the sales manager. The customer are given 1 month period to settle their dues by checks. Ms. Cheng will prepare the deposit slip every day for the checks collected through postal mail and hand over to the cashier for depositing in the bank. It shows that the sales transactions are recorded on the correct dates. Finally, she will enter the transaction of the collected checks into the ledgers to the credit of the individual customer. Ms. Cheng's goals in this situation was to complete the posting on summarization task. This is because she wants to deal with the correctness of the information transferred from the ledger to the recorded transaction.
So I'm going to explain about the sales and collection cycle. For the sales and collection cycle, there are 5 classes of transaction, which are sales, cash receipt, sales return and allowance, write-off of uncollectible account and bad debt expense. So there are the relevant account, business function, documents and record for the sales and collection cycle. So firstly, the relevant account for the sales are sales and account receivable. Therefore, the function are for processing customer order, granting credit, shipping goods, billing customer and recording sales. Secondly, the relevant account for cash receipt are cash in bank and account receivable. This class of transaction is used for processing and recording cash receipt. So thirdly, the relevant account and the document for the sales return and allowance are sales return and allowance and account receivable. The function of this class of transaction for a business is processing and recording sales return and allowance. So next is for write-off of uncollectible account. The relevant account are allowance for uncollectible account and account receivable. So last but not least, in sales and collection cycle, there are bad debt expense, and the account that will be used are bad debt expense and allowance for uncollectible account to record them and use for providing for bad debt by using general journal.
The typical accounts included in the sales and collection cycles are sales account, account receivable, cash in bank accounts, sales return and allowances accounts, allowable for uncollectible accounts, and bad debt expense account. Sales account contains the record of all sales transactions. This includes both cash and credit sales. Then, account receivable is the balance of money due to a company for goods or services delivered or used but not yet paid by the customer. Cash in bank accounts are cash maintained in the financial institution, which are usually the banks. Next, sales return and allowances account is a contra revenue account deducted from sales. It is a sale adjustment account that represents goods returned from customers when the customer accepts broken goods. Allowance for uncollectible account is a contra asset account on the balance sheet representing account receivable the company does not expect to collect. Lastly, bad debt expense accounts is related to a company's current asset account receivable. Based on the case study, Ms. Chang recorded the sales in sales account and account receivable while receiving the orders from the customer through postal mail and telephone and to fulfill the existence and occurrence objective. To carry out completeness objective, Ms. Chang prepares the deposit slips every day for the checks collected through postal mail and hand over to the cashier for depositing in the bank. In this situation, Ms. Chang records in account receivable because the transaction is on credit sales. When the company receives the amount, Ms. Chang will record the amount in cash in bank accounts. Lastly, to achieve valuation or allocation objective, Ms. Chang will also send reminders to customers for the shortage or differences in the amount received. On receipt of suitable replies from the customer, Ms. Chang will credit their account as a rebate or an allowances. The transaction will help the clerk to process and record sales return and allowances with sales return and allowances account and accounts receivable.
So now we move to internal control. Internal control is a process designed to provide management with reasonable assurance regarding the achievement of management's objective. In this category, which are reliability of financial reporting, effectiveness and efficiency of operation, and compliance with applicable laws and regulation.
There are 5 components of internal control that management designs and implements to provide reasonable assurance so that its control objective will be met. First, control environment. Second, risk assessment. Third, control activities. Fourth, information and communication. And last, monitoring. Okay, each component contains many controls, but auditors concentrate on those designed to prevent or detect material misstatements in the financial statement. The auditor uses the information obtained in understanding internal control to assess control risk. There are 4 essential steps to these assessments. First, the auditor needs a framework for assessing control risk. Second, the auditor must identify the key internal controls and deficiencies for sales. Third, after identifying the control and deficiencies, the auditor associates them with the objective. Last, the auditor assesses control risk for each objective by evaluating the controls and deficiencies for each objective.
So, based on the case study, the key existing control that is suitable with assertion for occurrence and existence is that each of the sales transactions should be supported by necessary documents such as invoice, shipping document, and approval sales order. For example, when the sales order received through postal mail and telephone are handled by Ms. Chang, an account clerk who will immediately raise the sales invoice in quadruplicate copies.
Showgoods never had those proper authorization before delivery of the goods. For example, NCSI will forward the invoice to the storekeeper together with the dispatch advice for delivery of goods. The storekeeper then will make arrangement to deliver the goods immediately after the receipt of the advice. This situation, the company makes a proper authorization to prevent the loss of the company assets by shipping to fictitious customers who will fail to pay for the goods. But Showgoods Neighborhood should ensure that the shipping documents are pre-numbered and accounted, and ensure that batch totals of quantities shipped are compared with quantities billed. So this case study situation refers to assertions for completeness. Based on case study above, that can be related with the assertions of valuation or allocations. The statement in which the original copy of the sales invoice is sent to the customer because they had to settle their dues by checks. After that, Ms. Chang posted the transaction of the checks collected to the ledger to the credit of the respective customers. This also shows that Showgoods Neighborhood should use computers because it will automatically post transactions to the account receivable master file and general ledger. And the account receivable master file is reconciled to the general ledger on a monthly basis, such as Ms. Chang prepares a schedule of account receivable once in 3 months and reconciles it with the account receivable control account.
Test of control. Test of control is the procedures to test effectiveness of controls in support of a reduced access control risk. Okay, what happens if the test of controls support the design and operation of controls? If the result of test of controls support the design and operation of controls as expected, the auditor uses the same access control risk as the preliminary assessment. However, if the test indicate that the controls did not operate effectively, the access control risk must be reconsidered. Case study, occurrence or existence. First, examine customer order for evidence of credit approval. Second, examine sales invoice for supporting bill of lading and customer order.
Next, the test of control related to completeness is synchronize the sales order forms to identify if they are properly accounted by using pre-numbered shipping documents. In this case, Ms. Chang has followed the step in order to complete the sales order that she received from the customers. Firstly, she starts with receive the customer order through postal mail and telephone. Then she provides the shipping document and Ms. Chang raised the sales invoice in quadruplicate copies. After that, she sent the sales invoice to the customer directly by the sales manager and post the transaction of the checks collected to the ledger. For the last steps, Ms. Chang prepares a schedule of account receivable once in 3 months and reconciles it with the account receivable control account. Besides, in the term of valuation and allocation, the test of control is examine the proper approval for customer's order and delivery notes and examine indication of internal review for recording sales transaction. From the situation, Showgoods Neighborhood should assign senior staff to review the customer's file for references, credit checks, and authorization of our account receivable. The senior staff need to ensure to trace the checks to sales transaction in general ledger and record correctly and inquire if there is missing numbers during the process.
Next, we will discuss about substantive test. What is substantive test? Substantive test is performed to help auditors determine whether monetary misstatement exists in sales and collection cycles. Next, I will discuss the first substantive test, which is recorded sales for shipment, which is trace the amounts to the perpetual inventory, recorded as a test whether inventory was reduced. Next is reviewing a numerically sorted list of recorded sales transactions for duplicate numbers. Next, trace customer information on the sales invoice to the customer master file. Lastly, trace the credit in the accounts receivable master file to its sources. Second substantive test is existing sales transaction are recorded, which is trace selected shipping document from a file in the shipping department to related duplicate sales invoice and the sales journals. The third substantive test is sales are accurately recorded, which is compare price on duplicate sales invoice with an approved price list.
The next substantive test is whether the sales transactions are correctly included in the master file and correctly summarized. The auditor will perform some clerical accuracy tests, such as footing the journals and tracing the totals and details to the general ledger and the master file, to check whether there are errors or fraud in the processing of sales transaction. Recorded sales are correctly classified. Auditors commonly test sales for proper classification as part of testing for accuracy. They examine supporting documents to determine the proper classification of a given transaction and compare with the actual account to which it is charged. Sales are recorded on the correct dates. Auditors commonly compare the date on selected bill of lading or other shipping documents with the date on related duplicate sales invoice, sales journal, and account receivable master file.
I will discuss about case study under substantive test. First is, the auditors can do substantive test of transaction for the occurrence and existing objective. They can watch selected entries in the sales journal to related copies of shipping and sales document to make sure they are okay. Next is for the completeness objective. Auditors cannot do substantive tests, but auditor can test for unbilled shipments by using selected shipping documents. Under variation or allocation, there are 4 objectives. The first that we discuss is about accuracy. Substantive test is to meet the accuracy goals. The auditor must conduct substantial tests throughout each audit to ensure that all transactions. Auditors can check duplicate sales invoice price to an approved price list and compare invoice details to shipping records for quality and customer identification.
As part of the accuracy testing, auditors might conduct substantive tests on sales to ensure accurate classification. They can look at supporting papers to identify a sales invoice paper classification and compare it to the account to which it is charged. After the customer receives the original copy of the sales invoice, it should be and recorded as quickly as possible to avoid the unintended omission of transactions and to ensure that sales are recorded correctly. The auditors commonly compares the date on selected other shipping document with the date on related duplicate sales invoice when doing substantive tests. Lastly, the auditors can trace any entry from the sales journal to the master file. Tracing from the sales journal to the master file should be done to meet the posting and summarizing goal.
Evidence is defined as any information used by the auditor to determine whether the information being audited is stated in accordance with the established criteria. Evidence includes information that is highly persuasive, such as the auditor's count of marketable securities, and less persuasive information such as responses to the questions of client employees. Auditors use audit evidence in many different forms and sources. Those audit evidence could be data or information, physical or non-physical. Based on the case study above, the audit evidence is such invoice as Ms. Chang has issued when she received order from customer through postal mail and telephone. She has raised the sales invoice in quadruplicate copies before forward them to Encik Syaiful, the sales manager. The sales invoice is used as written evidence on sales of goods, whether cash or on account, which is credit to the customer. In this sales invoice, there are details of the household electronic appliances that Shogun Cinderella Bread sold. There is also delivery notes as evidence in sales of Shogun Cinderella Bread. By using delivery notes, it helps the company get a better overview of their input and output, while also giving their customer a way to check whether they have received all of the products they have paid for. If anything is missing, the recipient can quickly respond and contact the company using the delivery notes to inform them. Other than that, Shogun Cinderella Bread used bank reconciliation as evidence that Ms. Chang prepares the statement once in 2 months. Therefore, when fraud arises, it can often be quickly spotted by performing and reviewing a bank reconciliation. By reconciliating, also can identify any irregularities such as entering wrong amounts, duplicating entries, and other data entries errors during.
Possible misstatement. A misstatement occurs when anything in the financial statement is not treated correctly, implying that the applicable financial reporting system, particularly IFRS, has not been properly applied. It can be because of an error or fraud. The misstatement can lead to overstatement or understatement. Overstatement. An overstated balance is an account balance that is reported as having a greater balance than it actually does. Understatement. Understated balance is one that is reported as having a lesser balance than it actually does. Case study. First, occurrence or existence. In this assertion, it can be overstatement of sales, overstatements of account receivable. Completeness. Overstatements or understatements of account receivable, misstatements in related account receivable and related income statement. Next assertion is a valuation or allocation. It can be overstatement or understatement of sales and account receivable, overstatements or understatements of sales and allowance and account receivable, overstatements or understatements of allowance for uncollectible accounts and bad debt expense.